The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, ACCA members. Welcome and thank you for joining today's session on a Monday evening. My name is Danish Shamsi, and I am the Regional Business Development Manager for ACCA Middle East. I lead the regional employer strategy at ACCA, and I'm also the voice of our members. And it is also my responsibility to support our small to medium-sized practices in the region. Today, I'm delighted to bring you this three-part webinar series, which provides you with a recap of public clarification on tax procedures and VAT. During the series, tax expert and fellow ACCA member Sidra Salman will share a detailed explanation of each of the public clarifications, including examples and real-life scenarios of each one. Sidra Salman is the co-founder and managing director of Sidra Salman & Co. Chartered Accountants. She is also a fellow ACCA member. She has many years of VAT experience, particularly working with clients to help them develop and implement indirect tax governance frameworks, structures, and related policy protocols. Sidra has sound knowledge of IFRS, accounting, business operations, regulations, all which make her different from others in order to provide comprehensive financial solutions in all areas of the financial spectrum. Her clients cut across industries including retail, hospitality, healthcare, and real estate. Should you have any questions during the session, please feel free to drop them in the questions box. We have dedicated the last 10 minutes of the session for Q&A. And on behalf of ACCA, I would like to thank Sidra for taking the time today to support ACCA and for taking time to deliver this tax series for us. Thank you very much, Sidra. I hope everyone enjoys today's session.
Hello, everyone. Good evening. Thank you very much, Danish, for your introduction and the detailed insight. Thank you very much for having me today for the recap of the public clarifications. Thank you, everyone who take time out of this busy day and listening to this VAT webinar. Thank you very much, everyone, for attending. So actually, this is the webinar which was much required, as in my opinion, because actually I have been working on many of the tax procedures related to the VAT implementations and including the VAT administration. So I can see a lot of potential to be over here, and this is something which still need to be improved, and still the people, ACCA members or ACCA students or other professional qualifications, they need to be educated on the same. So this is why we chose this topic of the public clarifications, because this is more concise, more comprehensive, and more recent update on the Decree Law number 8 of VAT and Executive Regulations number 52 and 56 of 2017. So we will be discussing about the public clarifications, and there will be three parts of this seminar. There will be a series of three parts. Today we'll be doing out of one out of these three. So 15th November we will be having a recap of public clarifications. Since the VAT is implemented, we all know very well that since January 2018, there are many implementations which has been done by Federal Tax Authority, which is a regulating body for the UAE, to administer the laws and VAT and the implementations and the penalties, to enforce the administration and to follow up on the same. Since the implementation of VAT, there are many public clarifications which has been issued. There are 27 VAT public clarifications which has been issued so far, and there are 2 tax procedures public clarifications. Tax procedure is something which we will take it apart and we'll discussing in the last part over series, because tax procedure is something which is very important. But before that, we need to know how does the VAT implications are important to be discussed on each of the transaction of the business dealings. So these are the key updates since the VAT has been implemented, which is value added tax. There are 4 business related business bulletins which has been issued. There are 5 excise tax related guidelines. There are 8 excise tax public clarifications, and there are 24 VAT guides. This is other than I mentioned 3 of the laws. One is the Decree Law number 8, other one is Executive Regulation 52 of 2017, and third is Executive Regulation 56 of 2017. These documents which everyone can see on the screen, this is other than these 3 main areas of the VAT, which is our basis. So objective, so first of all, we need to understand what is the authenticity of these public clarifications, which has been, which we are discussing one by one today. So public clarifications is also issued by Federal Tax Authority, and it has been carefully brainstormed and carefully thought, and has been taken into account all the daily life or the practical problems which the businesses, small, medium, or large size businesses are suffering in daily life. Because there are many things, there are many business transactions which are still which people still find unexplained in terms of the VAT, which are not very much clear. So this is the reason public clarifications has been issued, and they are as authentic as any of the decree law or issued by Federal Tax Authority, but they do not supersede any of the decree law, any of the clause, any of the articles of either decree law number 8 or Executive Regulation 52 and 56. Public clarifications are only giving the users the guidance that how they can exercise their rights and how they can fulfill their obligations as per the UAE tax systems, just to support them not to have an unnecessary administration cost. Where you can find in public clarification, it is easily available on www.tax.gov.ae/public clarifications. Whatever public clarification is issued recently, everything is updated on that. And I believe that being a professional chartered accountant, it's our responsibility to keep our knowledge updated in terms of public clarifications or VAT decree law number 8 of 2017. So these are all the public clarifications which help us to understand more the technicalities of the system and give us the customized solutions to our problems of the daily life in implying the VAT laws. We will be starting with the first public clarification, which was issued in June 2018, and it's the code is P001, and it was about the compensation time payments. It was issued in June 2018. So first of all, we need to understand that what do we mean by compensation time payments. So these are the payments which a taxpayer is receiving other than the normal consideration of a supply. So the word supply is something which is very important in VAT dictionary. So what do we mean by supply? So supply is actually the supply of goods or services for the consideration by a taxable person in the state which is the UAE. So whenever there is a supply, we have to consider that if on that supply the VAT has any implication or not. If this is not a supply, we have to forget about the implication of VAT rules on it. So the word supply is always draws the central attraction towards the VAT implication, towards the VAT laws. So these are the payments which a taxpayer is receiving other than normal consideration of the business. What could be these payments? These payments could be, there could be 2 types of payments. There could be contractual payments and there could be non-contractual payments. So first of all, we need to understand about these 2 cases. So cases are there, liquidity damages. So there are the liquidity damages which are a part of many of the contracts when we are supplying the services or the goods. So what do you mean by it? It means that when a person is getting compensated with the loss of revenue or with the damages of the goods. So in that case, it is the consideration which has been received by a taxpayer, although it is a consideration received, but it is not a supply, and it is outside the scope of VAT. It is not subject to VAT. So I will stop here to consider three terms which are very important along with the supply. Okay, and there are three terms. So one is called, there is standard rated supply, the other one is zero rated, the third one is exempt, and the fourth category is out of scope. So it is not a supply, or it is not an it is out of scope. So three implications related to standard rated, zero rated, and exempt. These three categories are important for VAT because it will restrict you to recover the VAT, input VAT, which you have already paid on your purchases. So that is why when we say that it is a supply or not. If it is a supply, it will be subject to three cases. One is standard, zero rated, or exempt. If it is not a supply, then it is not subject to VAT and it is out of scope. So this is where I stop. Now let me get back to liquidity damages. So all of the liquidation damages which a person is receiving, which a tax person is receiving as a part of compensation of the early termination of the contracts, as a part of compensation of the revenue loss. So all these payments are out of scope of VAT and they are not considered as a supply for the VAT purpose. When we consider it's out of scope, it means that we do not have to show it in the VAT returns. It has nothing to do with VAT returns. It cannot restrict your authority or restrict your rights to claim the input tax credits which you have paid. So out of scope and exempt, they both seem similar, but in terms of taxation complication, this is entirely different. So liquidation damages, there are many examples of liquidation damages. For example, if you consider the nature of the contract between a tenant and the landlord. So in case it's a part of the contract that in case the check is bounced or some payment is delayed, so they will be charging X amount of the penalty. So this is as per the contract, but this is not this is a consideration which a taxpayer will receive, which a landlord will receive, but against that there is no supply. This is only for the compensation of the damages. So this is considered as the liquidation damages, and this will not be considered as supply for VAT purpose, so it will be entirely out of scope. These are the compensation payments. So, and then similarly, the example is if a late interest payment has been charged on invoice or something like that. So this is also on late delivery of the goods or something, some termination of the contract. So although it is contractual, but yes, it will not be related to the supply of the goods. So if there is no supply, there is no VAT. But there is another payments which are again contractual, but they have been received as a result of seizing the rights. For example, hotel booking cancellation fee. There is a fixed fee to cancel the hotel bookings, for example. So in that case, even it's a contractual, but there is a fixed fee for that, and it's not against the composition of the loss of the revenue. Okay, they seize the rights also towards that supplier, so that will be considered as a supply of the service, and that will be subject to standard rate, which is 5%. And then there is a payment for damaged goods. So now there are two cases. In case if the goods are damaged, so there are two cases. Although it's a part of the contractual or not, but if the title of the goods has been transferred to the person who damaged the goods, so in that case it will be a standard rate supply. But in case if the title of the goods cannot be transferred to the person who has to pay the damage fee, so in that case title of goods remain to the taxpayer, so that will not be a supply, okay, because it doesn't fit the VAT concept of the supply definition, so it will not be subject to VAT, and it will be out of scope. But in case if the title of the goods has been transferred for the damaged goods, in that case it will be a supply, and the VAT should be charged at the current rate, which is 5%. So the next public clarification, which again has been issued in the same time, which is June 2018, which is VAT P002. This is the second clarification which was issued by Tax Authority, and it is called profit margin schemes. So profit margin schemes, which I believe still as a part of my own review of the market and as a part of my client's base, that this is the part which is still being very much neglected or not very much practically experienced, because it does not relate to all of the operations, all of the businesses. It relates to a specific category of the businesses or to a business, but only related to a little part of the transactions. So that is why there is not much awareness about this profit margin schemes yet, which at least I can foresee from my industry's experience. So first of all, we need to understand that what do we mean by profit margin scheme? So profit margin scheme is applied on the goods which has been subject to VAT for more than one time. So in case if there is one supply which has been supplied again and again at different levels, so such supply cannot be subject to VAT at the standard rate of at the full price all the times, okay, because the supply is one but owners keep on changing. So in that case it will be subject to profit margin scheme. So what is profit margin scheme? Profit margin scheme means that the person who is having a such supply and who is going to make it, who is going to supply it to another person. So in that case, he has to charge the VAT at 5%, but not at the full selling price, but at only the profit margin. What are the invoice protocols, how to show it, how to calculate, this is coming later on. But anyhow, first of all, we need to check that what are the goods which qualify for the profit margin schemes. So these are only the tangible movable properties. Only tangible movable properties are eligible to be sold under profit margin schemes by taxpayers, okay, which can be sold after some repairs. There could be many examples. There are motor cars, there are coins, stamps, antiques, and there are many precious pieces of the archaeological. Widely used business is the second-hand motor cars business, which this is the part of the market or the part of the industry which are widely making a use of the profit margin scheme. There is another category on which we can apply the profit margin scheme. This is when a taxpayer is selling a motor car which has been used for a personal purpose of a staff. So what is the reason of that? This is what we will be discussing later on in today's part one, which is because whenever we are having an expense to be used, when business is incurring an expense for the personal use of the stuff, so in that case that ITC, input tax credit, cannot be recovered by the business. So if a business is selling such a motor car which is going to be sold out by the business but has been used by the company employees for the personal use, and the ITC was not recovered at that time by the company, so whenever the company is selling such goods, they can apply the profit margin scheme on it. They don't have to charge the VAT on the full selling price. These are the motor vehicles which are eligible to be sold under profit margin scheme. For the purpose of taxation, it's very important to know that what is the definition of motor vehicle. A motor vehicle is a vehicle to be used by no more than 10 persons. So it cannot be confused with the heavy transportation, with the forklifter, with the transporters, and with anything. So motor vehicles is clearly a vehicle or which can be used by no more than 10 persons. So that category is called motor vehicles. So this is where these are the goods which are eligible to apply the profit margin scheme. So now what are the conditions to apply the profit margin scheme? For example, there are many there are the cases when a good has been purchased. Good means motor car, coins, stamps, antiques, and all these things. The goods qualified for the PMS, which is profit margin scheme. So if it has been purchased from a supplier who has bought the goods back in 2017. So whatever the goods which has been bought in 2017 and has been supplied for the first time since the VAT has been implemented cannot be subject to profit margin scheme. Only those goods which has been subject to VAT earlier, okay, after the implementation, which is 2018, such goods would be eligible to be sold in a profit margin scheme. So if a good which has been purchased in 2017 has been, of course, there was no VAT on that, and it has been and is going to be supplied for the first time, that cannot be subject to VAT. It has to be sold at the full selling price, but it will be subject to VAT at the second time of the supply. So usually, actually, what is the basis? And if I summarize it, whenever such a good is going to be supplied which qualifies for profit margin scheme, whenever there is a second time supply which by a taxpayer, by a person who is registered for VAT, who has charged the VAT on the full selling price at that second level of the supply, it will be subject to profit margin scheme. So this is very important to know that it has been subject to VAT earlier or not. Invoice protocols are something which is very important. I will take a pause over here. It's not only for profit margin schemes invoice, because profit margin scheme invoice protocols are different from the normal tax invoice, but still I can see whenever we are experiencing different type of the clients, different industries, different sizes of the accounting department, that still the tax invoices protocols need to be followed very strictly. So now in that case, in profit margin schemes, the invoice protocols need to be followed strictly. So first of all, the name of the invoice should be its tax invoice under profit margin scheme. It has to be expressly written on the invoice that is a tax invoice under profit margin scheme. And description of the goods is very important to be written, and suppliers and customers TRN should be written over here. Usually this is not a requirement for a normal tax invoice. If the invoice value is less than 10,000, only supplier TRN is enough. But in case of profit margin scheme, no matter what is the value of the invoice, both TRNs should have been mentioned. Date of supply, place of supply is something which is very important. There is no need to mention specifically that what is the profit and how the VAT is calculated on that. But the VAT, the 5%, which is current rate of corporate tax authority, 5% need to be charged only on the profit. For example, if let me express an example of a motor car, if it has been purchased in 2018 from a tax registered person at 100K and now it has been sold at 150K, so the VAT should be charged only on the 50K, but 50K should not necessarily be expressed on the tax invoice, but VAT should be charged not on 150K. VAT 5% should be charged only on 50,000, which is your profit. So these are the protocols of a profit margin schemes. In profit margin scheme, there is one thing which is very important to mention here, is that it's the supplier's responsibility who is now supplying. So it's the supplier's responsibility actually to make sure that the goods has been subject to VAT earlier or not. So for that purpose, actually tax authority says that you should have an access. You should be asking for the actual purchase invoice, which definitely is not practical so far. There is no option that, for example, Altair Motors or Al Fateh will be showing you for second-hand cars, they will be showing you the actual invoice that how much they have purchased and they were subject to VAT or not. It's something which is not possible. So this is why there is another mechanism. You have to look for the active alternative resources just to make sure that the goods has been subject to VAT or not. For example, in case of cars, the cars, whenever it's post registered, all the records are with Road and Transport Authority, so you can actually get to know very easily that when the car was first registered. If it was registered in after 2018, it means that it should have been subject to VAT if it has been supplied by taxpayer by a tax registered person. So these are the common ways which you can find out, through which we can find out that the goods has been subject to VAT earlier. And this is in respect of cars, but in respect of other goods which qualify to be supplied under profit margin schemes, which cannot be, whose data are not available readily on other databases. Through that, the tax invoice through is something which is an sufficient evidence to show that this has been subject to VAT earlier, and now the second time supply or third time supply should be under the profit margin scheme. So profit margin scheme is something which I suggest everyone to read and to understand the mechanisms very carefully, because there are different scenarios on it. So this is the second public clarification which was widely discussed at that time, and this was a reason that out of many important topics, this was chosen as the second public clarification to be issued by the government. Okay, so now there is for today's webinar, this is the number 3rd, but actually on the Federal Tax Authority list, this is the 5th one, which is called non-recoverable input tax. This is on the entertainment services. Why I have chosen this as a part of it after number 1 and 2 as a third to be discussed here, because all these things are very important, and whenever we are doing the tax audits of our clients related to different industries, I can see that there is still an ambiguity on it, and the accounts department or the finance professionals are not having clarity on that, how to restrict themselves to claim the ITCs. So usually the practice is that whatever the invoice someone has received is a tax invoice, a proper company name is there, TRN is there, the supply is there, so we can claim VAT on it. But this is not the case. There are many entertainment services which are specifically excluded to be to recover the input tax credit, and in that case, the VAT of 5% on those services will become the company's cost. So this is the reason which why I have chosen it as an entertainment as a third topic to be discussed today. So first of all, we need to understand that how the entertainment is defined in the VAT laws. So entertainment is something which is hospitality of any kind. It is incurred by the business for personal use of the staff or for the prospective business. It can include the potential customers, it can include the potential candidates, it can include the potential investors, it could be the board of directors meeting, it could be of anything. So entertainment is something which is defined as hospitality of any kind. So what does entertainment expenses include? How does it look like? What are the examples? Examples usually is your meals cost, your staff meals cost, your accommodation, trip cost. It could be long service rewards, it could be expensive watches, it could be some annual dinners, it could be some staff gathering, some religious gathering or something like that. So everything which has been incurred for the personal use of either staff or potential customers or the investors, it has to be the entertainment. So now there are two types of the entertainments. Entertainment is provided to the one who are employed by the company. So now that for the two categories for it, if it is provided by those which are government entities, so in that case, or provided by those which are non-government entities, there is a list of the entities which has been described as a government entities. It is your federal ministries, it is your public institutions in the state, it includes the cabinets, it includes the government bodies. So whatever the entertainment expenses which has been provided to those who are employed by the company, either by government entities or by non-government entities, it is always irrecoverable. So it means that 5% will become the cost of the company. So it is always irrecoverable. There are some exceptions to it. What are the exceptions? Exceptions are that it has been required by the contractor, it has been required by the government to provide those services. For example, if we talk about the medical benefits, for example, if we talk about some other benefits which are required by the labor law. So in that case, although it's for the personal use of the staff, and but this is something which is which companies, either government entities or non-government entities, they can actually recover it. The second one is that it's incidental to perform the duties. Whenever worldwide, wherever the taxation is, indirect taxation is implemented, whenever it is incidental to perform the duties. For example, if we talk about the janitors, if we talk about the cleaners, if we talk about the security persons, if we talk about the ministers who has to live near to the parliament lodges to perform their duties, although they belong to different states, different areas, something like that. So janitors, living rooms, all they have been provided with the personal benefits by the company, but without it they cannot perform the duties. So this is where it makes those expenses, the VAT on those expenses, recoverable by the companies. Then there is another category which is called as entertainment provided to those which are not employed by the company. So they are the persons who are not employed by the company, but we are providing entertainment services to them. So these are your potential employees, these are potential investors. So all these are the persons to which we are providing the entertainment. So for non-government entities, for the public sector, all these expenditures are considered as hospitality, and it is specifically irrecoverable. Only for the government entities, because for government entities they are more involved in philanthropic services, they are more involved in the in serving the people at large and serving the public at large. So for them, it's actually the part of their routine jobs. So for any expense which has been incurred by the government entities on entertaining the delegations, on entertaining the potential investors, or some categories like that, they can claim the ITC on that. But for the public sectors, for all those employed not employed by the company, all of the VAT becomes irrecoverable. There are some of the expenses which again considered as entertainment, but it has to be considered as a normal business expenses, and it can be claimed as a normal, and the ITC on those can be claimed as a normal. There are some business, like for example, if there is tea, coffee, or there is some luncheon vouchers which are provided to the company and which is available to all of the employees, the same rate, same standard, same category. And if there are some normal gatherings for the team building purpose, for such purpose, so in that case it's not something which is of the level which the business does not really do. It's the routine of the business. So these expenses could be a business expense, and they allow to recover the input tax on that. So in that case, it will not be the business expenditure. So this is very important to understand, and to know that what are entertainment expenditures and where it becomes irrecoverable. Again, another one, which is the P010, it was issued in January 2019. The reason of choosing this topic is very simple, but I still understand that there is a need to dig down more into these articles, into these clauses, to understand more on that, to understand how the exempt is different from out of scope, how the zero rated is different from the exempt, and how the zero rated is different from the out of scope, because in all of these categories we have no VAT implication. We do not have to charge in financial terms, but in terms of tax procedures, it's very different from each other. So the reason why I have chosen this, because in the normal courses of the business, this is not a very normal transactions to be dealt with in normal accounts and finance departments. But this is something which everyone should know, being a professional or an accountant, that what do we mean by how the VAT apply on bank interests and dividends. So first of all, we need to understand that from where this public clarification came from. This came from financial services, and this financial services include many things. It includes that equity security. It includes your life insurance contracts. It includes Islamic insurance contracts. It includes loans. It includes advances. It includes working capital credit. It includes credit facilities. So all these financial services come under this public. This public clarification is originated from these financial services. So whatever the payment is being made for the interest or dividend has been collected, it's considered as a financial services, and financial services are exempt from VAT. When we say exempt, it means that a taxpayer or registered person which is receiving the interest and dividend, they are doing the exempt supplies, and exempt supplies means they are not eligible to be registered for VAT, and they're not eligible to recover any type of ITC which they are incurring on the business expenditures, no matter it is related to compensation time payments, no matter it is related to your entertainment. They're not eligible to register for VAT. So this specifically include exempt services, but again there is subcategory which is called, there is a passively earned interest income and dividends. When a deposit has been fixed with a bank or the share has been purchased but the person is not involved in the executive management of the company, they are not involved in deciding that how much dividend has to be disclosed, they're not involved in the operations of the company, so all these dividends are passively earned by them. So in such case, even it's not an exempt category, it's not a supply even, so it's your out of scope VAT. So there is no requirement to show out of scope on 201 form, which is your VAT return form. But there is some other arrangements which has been done by the group companies or by the investors. So if there is an explicit fee or commission or rebates or discounts, etc., to arrange the above financial services inside the UAE, if there is a fixed fee to arrange it, if there is a fixed rebate to arrange it, if there is a fixed commission to arrange it, okay, to get a better interest rates on the passively interest income or something like that, such considerations is a supply, because there is a supply. It fulfills the criteria of the supply definition, the concept, and it will be considered as a standard rated supply. Similarly, if there is such arrangement of the financial services which has been done outside the UAE, which has been supplied, the services have been supplied to a business which is not residing in the UAE, which is outside the UAE, in that case it is a supply, but being outside, it is subject to export of services, so it will be subject to zero rated. But zero rated means that we can claim, we are eligible to claim all of our ITC, restricting irrecoverable ITC as per different clauses. The recent example is your entertainment clause. So this is something which is very important for us to know, the bank interest and the dividends. So this is where it's called disbursement and reimbursement. This is issued in July 2019. Again, a very widely discussed topics since the VAT has been implemented. It's not related with any of the article. This is a pure public clarification which relates to many aspects of the clauses and the conditions of the different documents which has been issued by VAT, by Federal Tax Authority, VAT Decree Law number 8, Executive Regulation 52, 56 of 2017. So this is covering actually the concept. This is unlike the latest slide which we discussed about financial services, in which we were targeting financial services, but here the target is not a specific condition or the clause or the article, but actually it relates to the concept. So the concept is that there are many transactions in the business which a business is doing on the other business behalf. So in that case, what could be the VAT treatment? Because usually when the VAT was implemented and when the person started indulging in it, the business started registering for VAT and starting understand how to do it. So this is the need to arise that how to deal such transactions which a business is doing on someone's behalf, which is other than the normal supply of the business. So how to deal with such transactions. So this is actually your disbursement and reimbursement. We will discuss first the reimbursement. Tax authority comes back with explanation that what do we mean by reimbursement? When a taxpayer incurs an expense as a principal in a business deal or a transaction, it is called reimbursement. When a taxpayer is able to decide that what to make the expense, they are able to decide that how the transaction need to be routed when they are the one who are receiving the invoices under their names and under their name but on someone else's behalf, but they are paying, they are receiving the invoices on their behalf. So whatever the services are, it has to be considered as reimbursement, and it is subject to standard rate, which is currently is 5% of VAT. The term disbursement, there are many expenses which has been paid by the taxpayers, which has been paid by or on someone's behalf, but as an agent in a business relationship. So it is not subject to VAT. It is outside the scope of VAT. So it's something which you can completely ignore while preparing the VAT 201 form. So this is how the difference is there. We will discuss the examples, daily life examples of reimbursement and disbursement too. So in this slide, we will be discussing the examples of reimbursement. For example, there are very common criteria, common transactions or common dealing is that group company, whatever the group company is there, they are responsible for hiring the staff. They are responsible for hiring the staff, but the staff is working for the regional, including the head office. So in that case, all expenses are invoiced directly to the group company, and they have paid directly by themselves. So in that case, whatever the employees who have been onboarded, whatever companies they are working in the group, group company ABC in the particular example one, they have to charge the invoice for their portion. For example, if there is a staff of having a salary of let's say 30,000, so in that case, they are the one who actually paying them. They are the one, because the staff as per the UE labor laws is working under the WPS of the group company ABC. They are the one who are responsible to provide the medical insurance, the benefits, air ticket, annual leave, and everything. So whatever the expense they have been incurring, it has to be a portion over the three companies which are sharing the services, and ABC will charge. Will issue them a normal tax invoice. It could be under markup, it could be at the markup, it could be at the same rate which they are paying the salary. It depends upon the companies to companies that how they want to see it, the consolidation or the costing structure and everything. But anyhow, they have to charge the VAT on it, and it will be a normal tax invoice for the services which are shared by the group companies, but the resource was hired by company ABC. Because in that case, it will be a very straightforward thing, because ABC, the group company, is the one which has which received the invoice, so they are the one to recover the VAT on it, and they have to make it as a supply also to make the VAT cycle as a balance. Then example 2 is a very common mechanism followed by the shipping agents is the VAT. They have implemented. We all know very well that that there are different, the FTA, Federal Tax Authority, is linked with custom codes. Both departments are linked. So in that case, if a shipping agent is there and which is clearing the goods as a principal, and they have the goods come under the shipping agent names, and they are using their custom code to deliver the goods. So in that case, they are the one who are going to record it as an RCM. So they will be, whatever the supply they will be to the actual owner, it will be a case of charging the standard rate invoices. It could be again the same amount or the markup invoice. It depends upon the business ratings and the business structure. This is the second example. Third example is in case of charging of certain hospitality expenses. This is the one which we have discussed in the second step for irrecoverable entertainment expenditures. Sometimes there are the services which are purchased. There are the expenses or services incurred or purchased by the company for the personal use, for the employee's personal use, on which they cannot charge on which they cannot recover the ITC as per the relevant article of the VAT Decree Law number 8. So in that case, whenever they recover the expenses from the employee, it will be considered as supply, and it will be subject to standard rated tax. A very common example is if the company has provided their employees with the mobile phone SIMs. So whatever, but they have allowed up to a certain limit. So whatever the limit is crossed, the employees has to pay. So the bill is actually made by the telecommunication company. The bill is made to the company. But of course, it's for personal use. They cannot claim all of that, and they are reimbursing. So whatever they are going to reimburse from the employees against their salaries, they are going to deduct the extra amount from their employees. So in that case, it will be considered as a deemed supply, and it will be subject to standard rated taxation. Then we are having an examples of disbursement. There are the invoices. Again, I will take in the same example which we have taken in reimbursement, but the position of the group company has been changed. When the expenditures, the employees are onboarded by the group companies itself. Okay, but group company, which is the parent company, actually this is the one who is just making the payment on their behalf. So invoices has been received by the group companies, by the sister companies, and they are responsible for getting the insurance or for getting all of the protocols as per the labor contract, because specifically we consider the example here of onboarding a resource but provide the shared services among the group. So in that case, ABC does not receive any invoice. ABC is not legally responsible for to follow any of the legal protocols. So in that case, it will be considered as the disbursement category. They can make the payment, but they will issue an invoice called disbursement category, and it will be out of scope. They can make the payment, and they can receive the same payment under the disbursement without the stress of the VAT implications. So it will be specifically out of scope because not a supply. Similarly, there are some logistic companies, for example, DHL, we have Aramex, we have many renowned logistic companies which are actually using the customer codes to clear the goods. So in that case, whatever the expenses they have paid, whatever the for example, carriage and freight and insurance values they have paid at the custom, whatever the transportation they have paid at the custom to get the goods cleared, it has been as an agent, because they did not use their own custom code, they use the customer's custom code. So it's a RCM for the customer itself, and they can charge the same amount, and they can receive the same amount from the customers without worrying about the implication of VAT, because they acted as an agent. So they can issue the invoice, simple invoice, which under the name of disbursement, the same amount which they have incurred, they can put it as supporting, and they can charge the same amount. So there is no need to show it in the VAT returns. It will be out of scope. Then there is an employee. This is the category of the business expenses which we have discussed in part 2, that where the expenses become recoverable by the company. When the expenses has been incurred, although for the personal use of the employees, but actually it is either required by the operations requirements to be provided, or it is required by the contractual obligations. So in that case, the ITC, the input tax credit, becomes recoverable for the businesses. So in the same case, if it has been recharged back to the employee, it will be a disbursement invoice by the company to the employee, and and there will be no VAT implication on it, but company can recover ITC as per the recovery rules of VAT laws. Here I would mention one more thing over here, that when we talk about the business expenses, so for example, if there is a hotel stay which has been provided to an employee who is a new joiner and who is new to the country, so it was required to start the legal or the contractual obligations. So in that case, it was required by him. Without it, it was not possible for him to start the company's work. So in that case, even it will be considered as a business expense. Even it has been recharged back to the employee, it will be disbursement by the company who's recovering the ITC on that expenditure. But it will be covered under recoverable ITC. It is not fall under the hospitality or the entertainment, which is specifically not allowed to be recovered by the VAT recovery rules of VAT laws. So this is about the reimbursement and disbursement. So that's all about today's webinar. Again, I will mention one more thing, that we all are ACCA family, and when I have been dealing with the different chartered accountant bodies, when I have been dealing with different accounts departments, different finance departments, I understand there are two problems circulating, and it's going round and round. And the one problem is that either people are too busy, too much obsessed, too much occupied with their regional, with their work, that they could not find the opportunity to read the VAT laws, or to understand it, and to explore it more, or to do the brainstorming on it. And this is where we are lagging behind. So I understand that this is something which is required. This is a requirement, and through that we all ACCA members can get an advantage, can get a competitive advantage if we get more into it, if we get more detailed insight into it, and if we do more often brainstorming on it. This is something which is very much required, and I really want to request all of you to keep your knowledge updated in terms of VAT, no matter it is a new clause explanation added, new article has been added, new public clarification has been added, or new procedure has been added. So whatever the things are there, we have to keep ourselves updated, because this is only a start. This is indirect taxation, but of course we are moving, UAE is moving towards the other type of taxations too. And this is where I feel that still this is an area which need to be addressed more open and more carefully. So I hope all this material have helped to understand into more technicalities, and it will give you the more clarity, and it will remove the ambiguity in case if there was any related to all these 5 public clarifications which we discussed today. So I hope it has helped out, and it gives a good insight to everyone and the clarification. Thank you very much, everyone, and I would like to take any questions in case if there is any.
Hi, Sidra. There's some questions in the question panel.
Yes, I can see it. Okay, so there is one question which is by Oksana Johnson, and they have asked that in case of composition, which is a taxable supply but related to 0% supply, the composition still treated at the same rate 0%. So the supply which is related to 0%, of course, in that case there is no need to be worried about. It's still 0%, but you have to show it in the zero rated supply, because the compositions, the supply itself, if it is 0%, the composition is something which has nothing to do. So composition will remain no matter it's related to 5% or 0%. It will, if it is related to liquidated damages, if it is a contractual, then in that case it will be out of scope. There is no ambiguity on that. It will be out of scope. You don't need to show it at in your zero rated supplies, which is your export of services or export of the goods. Okay, so the next question is, please comment on the medical insurance for Sharjah residents. Can it be treated as a common practice? Contractually, yes. Medical insurance, it is if it is required by the labor law, if it is required by even the company contracts. For example, if it is required by the company contracts, the company employment contracts, that they will be providing you the residents, the medical insurance, it's a contractual obligation, and whatever the employers are actually paying the VAT on such insurance, medical insurance or the other insurances, it's something which can be claimed by them if it is required by not only by the labor law, even by the company employment contract. There is another example. For example, we talk about the construction companies. So in construction companies, it is required by the companies to provide the meals at the site. So it is not required by the labor law to provide them the meals, but it's required by the industry practices, industry best practices. It is required by the nature of the job they are performing, that they have provided the meals. So in that case, whatever the catering they are paying, whatever the meals cost they're paying, they can recover the ITC on it. Okay, so the next one is, where do you classify the parking charges? And please also clarify the tax point of service. For example, company providing service to company registered outside the UAE, but the software where they are providing services can be accessed from anywhere in the world, even the UAE. So how should we decide a standard rated or zero rated? So in that case, we for the services, the point of the place of supply is something very important. If this is a software which has been provided to a company, which is used by a company which is a UAE resident company, in that case it cannot be an export or zero rated, it will be a standard rated, no matter from where it has been accessible. If you are giving the software rights to a company which is outside the UAE, in that case it will be export of service or zero rated. But in case if the company which is using the software is inside the UAE, no matter the software is accessible by persons outside the UAE, but still the supply is inside the UAE. So in that case, it will be a standard rated supply. Okay, so the next question is, entertainment expenses which has been incurred on customer project side will be input recoverable? No, specifically by the non-government entities. Whatever the expenditure which has been incurred in terms of the customers, either existing or potential investors or something like that, it will be straightforward irrecoverable. Yes, there could be an exception if this is the expenditure which has been incurred by a government entity, and some entertainment expenses has been done on a customer project side but by a government entity. So in that case, it will be recoverable. But in case if it is by a non-government entity, it is strictly prohibited to be recovered. So this is irrecoverable. So what advices can be provided to an ACCA member who is looking forward to know about VAT and its implication, provided they have no prior understanding or the experience? See, in that case, I suggest to subscribe to the Federal Tax Authority is running many seminars, many webinars. You have to keep looking at, keep visiting the FTA website, and there is a LinkedIn page also, which is actually giving more of the updates. As soon as there is a more update, as soon as there is a modification, as soon as there is a new public clarification, as soon as there is a new VAT guide, they are updating their LinkedIn page, and that you can actually follow it and you can get the recent informations. And I understand that this is a first step. The second step is to have the brainstorming to consider the different business scenarios with a group of the professionals who actually wanted to learn more, because every business is experiencing the different cases of reimbursement and different cases of disbursement. Every person is having different perspective, so you have to test it with the correct perspective. So in that case, it's important, number one, keep yourself updated with all of the updated knowledge of the Federal Tax Authority website. The second thing is to keep discussing and brainstorming with the same level of professionals. Okay, so in case of reimbursement of entertainment expenses, which is a taxable supply, so can the company claim VAT on these expenses? It depends on if the expense, entertainment expense, is normal business expense, and it was incidental. It was required by the employee to perform the job, just like I give the examples of the janitor or the cleaners or the ministers who are living near the parliament lodges. So this is how we are providing them. So all these entertainment expenses which we can recover. So if the company is going to recharge it to the employee, as a markup or a simple, and they fall in the reimbursement category, yes, you can recover and you can claim VAT on it. Okay, so would it possible for you to arrange a session on minimum corporate tax of 15% by G20 OECD? Yes, this is a new something which is newly coming up. So of course, this is a good idea. By the way, it's a question by Muhammad Ishaq. So definitely, Tonzok and Danish, they both are here, so we'll be considering it to be a second. Not only the current developments, we will be discussing about what will be coming up. So definitely, this is something which we can have a brainstorming session on it. What do the people think and how it's gonna be implemented? So in that case, the next question is, the company is registered outside the UAE. How the people are assessing it inside the? How the people are accessing it inside the UAE? Okay, so yes, this is also an interesting scenario in which the company is outside, but the services are enjoyed or consumed inside the UAE. So in that case, although the invoice is to the company which is outside the UAE, but the services are taken place inside the UAE. These are consumed inside the UAE. So in that case, it will be your standard rated service, although the invoice is towards outside the UAE. Okay, so in case of group one, can member of the group to claim input tax if it is tax invoice by the name of other company or the group company, or it's necessary to claim the company only? Okay, so in that case, it depends on the group of company. If the group, which is a legal group itself, it's a group, is registered as a group in on the Federal Tax Authority portal also. So in that case, we are reporting the consolidated picture. We are not disclosing in VAT 201 form specifically for the representative company and for the member companies. So it's a group. But why I should not suggest it to be, if the tax invoice is by a company, so it should have been claimed by the a company itself, because for the accounting purpose and for the tax reconciliation purpose also, it would be very much difficult. So for the financial purpose and for the VAT laws, if the legal structure of the group is registered as a group on the VAT portal also, it has to be the combined form. There is no specific segregation of between a representative company input VAT and member companies input VAT. But yes, for the consolidation, for the accounting purpose, for the representation purpose, and for the reconciliation purpose, it's always advised to be claimed under the company name under which the invoice is actually. Okay, so if the clearing agent is clearing the goods for the client and using the code of the client, so client will treat it as RCM or agent. If the clearing agent is using the client's code, so it will be the RCM for the client itself. Agent is acting as an the shipping agent clearing agent is acting as an agent only. So whatever the taxes, whatever the transportation, whatever the other charges they have paid on the client's behalf, they can just recharge it as a disbursement invoice without any VAT implication to the client, but it will be an RCM for the client itself. So the next question is, the company has a branch office in India and employees are working there from there for the Dubai office. How VAT will be calculated? So in that case, employees are working outside the UAE, and they are not being registered under the UAE labor laws also. And so whatever the expenditure which the company is actually incurring for them, they will all be your fall in irrecoverable category until and unless there is a requirement for the employees to come over here, stay in the hotel, and to do some kind of expenditure. In that case, that will become incidental to their job description. Without it, they cannot perform their duties. Then it will become recoverable. But anyhow, outside the UAE, we do not have any contractual obligations as per the UAE labor law towards them. So this is something. But yes, in case if there is, as a part of that, they are employees of the Dubai branch, but they are working in India. So in that case, if there's some contractual obligation as per the employment contract, so that can become recoverable. That's fine. But anyhow, related to employees, there is, I think, one more category, which is entertainment expenditure. Rest, all of the salaries and everything which are not subject to VAT. So I hope it clarifies the question. That's all. Yes. Is there any more question? No. For me, I can view all of these questions. That's it. Thank you so much, Mohammad Ishaq, for attending. Thank you so much, Salman, for attending. And I hope it was it helps ACCA family to understand more and to get more interested, to explore more, and to have a more brainstorming in the VAT implementation and the VAT laws. Thank you very much, everyone.
Thank you, Sidra. On behalf of ACCA, thank you very much for supporting us with this session. We look forward to part 2 and part 3 of the series. And thank you to all our attendees. Have a good evening.
Thank you very much. Thank you, everyone. Bye-bye. Have a good night. Thank you.